This is the Everything Financial Radio program. I am your host, Dennis Tubbergen. I am here every week at this time. Certainly glad you decided to tune in today. I have a terrific show lined up. Best-selling author and economist Harry Dent will be joining us today. Very pleased to have Mr. Dent back on the program. Always appreciate his perspective. You'll definitely want to stay tuned for that. I had a couple very, very relevant conversations with Mr. Dent this past week, and we'll be going to that conversation very soon. There was a Forbes article this past week I'll talk about asking if Ben Bernanke is losing control. There was in June a mass exodus from bond funds. What does that mean for bond funds moving ahead? We'll talk about that. And there's certainly a lot of opinions when it comes to what direction the price of gold will go from here. Mr. Dent has been bearish on gold. I'll get his opinion on today's program. However, there's a couple gold bulls that are also being quoted this past week in a Business Insider article. Who's right? I'm going to help you sort it out because I can tell you my opinion is it depends on what the Federal Reserve does. I'll sort that out for you in the last segment of today's program. And you know, if you go back and take a look at how fast debt grew prior to the subprime bubble bursting here in the United States back in 2008, and you look at the Nikkei bubble that burst in 1990 in Japan, you find that debt to GDP rose about the same percentage point during the same percentage basis during those time frames. China is growing debt almost twice that fast, confirming, I believe, a hard economic landing for China. We'll talk about how you might be affected as well. So a terrific program lined up today. Sit down, call your friends, tell them what we're talking about, and pull up a chair and listen. A quick reminder, if you have not yet visited our New Retirement Rules website, the web address is really simple, newretirementrules.com. And at that site, you'll find information about our New Retirement Rules class. The New Retirement Rules class is a 3-night class. We have our next session beginning on July 11. Just a few seats remain. The cost for the class for the 3 nights is $49. That covers completely all your books and handouts. We do limit capacity at the class. So if you want more information, just go to the website, newretirementrules.com. I'm pleased to have back on the program with me today, once again, best-selling author Harry Dent. Harry is a prolific writer. He is an economic commentator and demographic researcher, certainly looks at economies from a very unique and accurate perspective. And, Harry, it's great to have you back on the program. Thanks for being with us.
Yeah, nice to be back, Dennis.
Harry, when you were on the program a few months ago, your outlook for the stock market was quite bearish. Has your outlook changed?
A little bit. Well, I think we were saying back then, we saw it as a top before the top. We have had a correction of about 7% more in some indices. I still think you have, one more rally left that could either last a number of months or it could be brief if it's stronger. So we're looking for a top somewhere between maybe, let's say, mid-August and mid-January, kind of that time frame. It's kind of hard to tell. It depends on how the market rebounds here, how fast. But we haven't seen signs from some of the things we look for yet that for example, that May was the top, late May. We were not expecting that to be the top, but we are looking for something ahead. So we'll kind of have to just roll with it and see what happens. But another target we have is Dow 16,000. That's where there's kind of some major resistance. If we can get above that, it could go higher, but that's the most likely next stopping point. I would tell people I think you're almost certain to see Dow 16,000, maybe 6-7% higher than here. So I wouldn't be running for the gates yet, but if we see that, that's when the time to start saying, okay, maybe I'll take more of my profits and run.
Harry, I've talked to a number of folks that in this low-yield environment that have been looking to dividend-paying stocks to try to get some yield. What are you advising your clients as far as dividend-paying stocks and a potential market correction at some point here in the future?
Well, there's pros and cons in that. The good thing is that if you get a dividend over time, that's going to make up for any potential losses on the downside. But but everybody's been doing that, just like they were all moving into high-yield bonds. Well, we gave a sell signal for high-yield corporate bonds back in early May and said, look, this looks like it's topped here. So, when everybody's doing something, it's going to go the other way. So my problem is that, you may get 3% plus or minus dividends yields a year, but if the stock market goes down 50 to 60% in the next couple of years, that's not going to look so attractive. That's a high price to pay. So I think that's the best thing to buy, once we see a crash, and particularly in the demographic areas that are stronger, like, healthcare, pharmaceuticals, medical devices, biotech, maybe even areas like recreational vehicles, companies that do that, and travel, cruise lines are all things that will be favored more as baby boomers continue to age. If you can buy good dividend stocks in that arena, then that's the best of all worlds. But I'd say right now the market is too stretched. I'd say I'd be paring back on stocks in general if we move to new highs ahead. And then, if we get another healthy crash, which I think you're likely to see in the next few years, then that'd be a good place to buy because you get the dividends as well as a bounce. But I don't want to pay the price for that right now. I need 3% yield, but 50 to 60% is our higher end of the downside ahead, and that may happen sooner, that may happen later. But I think you're going to see large cap stocks hit new lows from what we saw in late 2008, early 2009. So that's. If we go to Dow 16,000, that means we probably go to Dow 5 to 6,000, and that's a 60% correction. That's too much.
Harry, you mentioned focusing on industries that were favored from a demographic perspective, and some of your demographic research is simply fascinating. Would you take a moment and just explain to the listeners a bit about your work in the area of demographic research and how it relates to your economic forecasting?
Yeah, it's on both levels. From the most macro view, people borrow the most about age 41. That's when mortgage interest peaks for homes, and that's 75% of borrowing. They spend the most at age 46. And upscale households will peak more like between 50 and 54. They invest the most, have the highest net worth at age 64. So on and on and on. That's the macro areas. The micro areas, it's just down to, entering the workforce at age 20, getting married at 26, you spend the most money on child care at 33, you buy your first house at 31, people do trade-up homes between 37 and 41, 42, and it just keeps going. Furniture at 46, people start traveling more, and first it's overseas travel to Europe and Asia, and then they get sick of that, and then it's cruise ships, And so really, from cradle to grave, we can tell people what areas that the baby boom generation, as they age, are going to be moving into, and what areas the next generation, the echo boom, is going to move into. And, of course, the echo boom's just starting to enter the workforce, and they're going to want starter everything, first car, starter home furniture. That's places like IKEA would be really good in the coming years, and they're in a strong rental surge right now. And that's one reason, in addition to homes being more risky and harder to get loans and all that sort of stuff, the echo boom is in a rental cycle and will be until about 2018. So that's another good place to be.
Here, we've got a couple of minutes left in this segment. We've seen really terrific sounding headlines when it comes to the housing market. In fact, I've listened to some of the pundits say that the housing recovery will lead the U.S. economy to recovery. Can you comment?
Yeah, and I think people are being misled here. This is mostly investors, everything from large hedge funds and pension funds down to individual local investors. It's not your normal first-time home buyers getting a mortgage. Applications for mortgages for new homes are barely off the bottom. So it's not the right people buying. Everybody's thinking homes are more affordable, home prices are down. Everybody's thinking real estate's going to come roaring back. It's not going to roar back. That is what I'll tell people right now. This is not going to last more than a short period of time. Japan has already shown us what happens here when you have a larger generation being followed by a smaller one. And in the case of Japan, it was much smaller, but even the U.S., when you add up all the echo boomers versus the baby boomers, the height of the demand for homes in the future is not going to be as high as it was. in the last boom, and at some point, as Japan's already proven, even when the next generation gets into home buying, which they will in the years ahead, the echo boom, the older generation, the people who are dying and who therefore put their homes back on the market as they go into a nursing home or they actually die, starts to offset the young people. And in Japan had about a 2-year minor bounce like this, not quite as strong as this, and then it ended. And I think that this is probably the last strong year you see for housing. So if people are selling homes, are looking to sell homes, do it now. If your kids are thinking of buying a first home, I would say, wait a few years and let's see what happens. I think there's another leg down in the housing markets, and only after we see that would I say, okay, coast is clear. So at least 2015. I do not think this is over.
Harry, as we close out this segment, if someone wanted to learn more about your work, what would you have them do?
Go to www.harrydent.com. We've got a free daily newsletter, which you can just listen to as long as you want, get a feel for me and my company's research, and then we've got other newsletters after that. But that's the best way to try us out because it doesn't cost anything.
Terrific. Well, we will continue our conversation with Mr. Harry Dent in the next segment when Everything Financial Radio returns. Stay with us.